we are live
Cool,
on
cool,
Facebook,
can.
so I'm gonna also start broadcasting and let people come in. So 3 minutes to go.
Sure.
We're gonna start the session right on time. Okay,
Cool,
great
cool.
to have everybody coming in right now. Okay, Lim, Wei Peng, Clement, Jess, Ken Sing, Kun Guan, Christine, Lok, Paul Chung, Prima, Chun Wei. Sorry, the names popping up quite fast. I cannot read all the name. I cannot call all of you, but really very happy to have you all here. So maybe I'll start with a warm-up question. Can you type in the chat box, or if you're on Facebook right now, can you type in a comment how much insurance premium you're paying each year? So like every year, how much is that? I guess, life insurance, it is quite hard to sell sometimes because when people commit, they are expected to pay every month or every year. So it's recurring. And what happened is that if you are buying a whole life policy, you're supposed to pay for whole life. Yeah,
Exactly.
and yeah, I was an insurance agent before last time. So it's like the major objection of buying insurance is that people don't like to pay regularly, right? People don't dislike. Well, if you want me to buy something, I can buy it one off, but you're talking about 2,000, 3,000 a year, then I have to pay every year 3,000. So it's recurring. So if as an agent, if you can handle this problem, say, no, I'm going to sell you a policy that is not going to pay for whole life. So you pay 4 years, pay 5 years, pay 6 years, 10 years, then that policy is much easier to sell. It's like 4 or 5 times easier to sell than the whole life one, right? And then
Just to relate to your description, Casey. Actually, I follow you since when you first started in back then. So it's awesome to see how you are where you are right now. And I always thought that if you can sell such a policy which is like short term, that would be selling like hotcakes. But right now, actually, because people are so used to the whole life already. Now this
really?
whole thing, the 5 year, 4 year thing, is like the other end of the extreme. So very weird.
Wow. So now is it easier to sell like a big policy, low premium, is it?
I think people are so used to it already that the sort of the investment linked policy,
I see.
which is no hassle. So people are used to the type of premium, and
Okay, we have some response here, and some people are paying ranging from 700 to 2004, 4008, 1,000 every month, and also there's one paying 30,000 annually, 30,000 annually for the whole family, right? So of course, that's not like high premium or low premium because it depends on your needs and also depends on your income. If you are making $1 million, paying 30,000 is rightfully correct. I mean, right? So, but if you are like earning 100,000 and you're paying 30,000, then that's not the right way to do it. But without further ado, it's time now. So we are going to start the session. We are going to reward all the people who are on time. So you're going to get all this firsthand. Right. So today we have Kaho, and Kaho is he's a independent financial planner. I think he's licensed to do this, and then he charge a fee to consult his client. And before we do this webinar, I was like talking to Kaho, hey, can you come and share like detailed case study? How do you turn around a client's finances? So if he's in bad debt, how do you turn it around? So we would really like to hear that kind of detail. So some people of you, if you are facing this kind of situation, I think Kaho will be the right person here to help you with that. So without further ado, Kaho, I'm gonna leave the floor to you, and I'll always be here to host it.
Thank you so much, Casey. Welcome everybody. It's really an honor that Casey have invited me back for the second time. I'm not sure how many of you actually heard the first webinar somewhere in 29 December, almost the end of last year, right? Maybe you want to type one into the chat box so that we can know. And also just like to share my screen. And if you can see my screen, do type 2 in the comment. so that at least I know you guys can see it. Thank you very much. Oops. Okay,
Yep.
cool. Yeah, so I've got this very interesting case study which I'm very eager to share with you. And just to give everyone the context, because we only have 60 minutes, right? There's a lot of stories that we would like to share. But we want to get straight to the point for those who are online today, because this is a method of how we can effectively save 3 times of your insurance premium without really sacrificing your coverage. And I think a lot of people, when we're in the investment world, Casey, I think we've always been brainwashed to hear that if it's too good to be true, maybe it's fake. No, but this is real. So we've got a case study to share that as well. All right, so is it okay if I just share a little bit for those who have not heard of me before? Maybe I'll take 5 minutes to share a bit about myself and the company that I'm in, all right?
Yeah, sure.
If
Please
it's
do
okay,
that.
give me the thumbs up, all right? Yeah, so my name is Kaho. I've been in the financial industry for the past 12 years. I've got my license somewhere about 5 or 6 years back, and I also started as an insurance agent. Mainly, I wanted to practice my financial planning skills back then, 12 years ago. And I think practitioner is very important here because you'll be able to tell somebody who, advise from experience or advice based on theory, right? So far we've helped 70 families and 300 individuals to date. Actually, my claim to fame is how I bought 16 property in 3 months. But actually, I don't intend, it's not for me to brag, but actually there's a lot of lessons learned, which I'll be happy to share with you, if we have other chance of coming back into the show, right? And of course, right now, there's a lot of people also struggling when they buy and when they over leverage on property, right? And I believe I'm also the one of the only financial planner to really put his own money into F&B and sort of turn it around. We actually raised, we did a private crowdfunding where we raised about 700,000. And of course, there's the whole complication, or rather the challenges of managing investors' money, right? I wanted to understand firsthand, so that when I advise or when I share or do it for my clients, at least I know what makes them tick, right? That's the whole gist of what I am. So I basically started sharing financial education since 2013. And of course, like Casey said that I'm a licensed financial planner. We actually charge our clients based on a fee of 3,000 to 10,000 depending on complexity. So the picture on the right is actually had an opportunity to share with 100 financial planners across Malaysia and Singapore, which was very honored because I was one of the first people who started fee-based. I mean, besides Meng Hui, right? He's one of the pioneers, of course. And so a lot of people ask me, what is J Advisory? How does it relate? J Advisory is actually not a financial planning company. It's actually a personal finance academy of helping families turn around, navigate out of their crisis without losing sleep. Because when I actually engage, or my clients engage me at the time, when we actually work out the whole strategy for them, we realize that a lot of them still not very sure what the strategy is all about, right? So this is an initiative I created last year during the MCO, when we couldn't meet face to face. So I took the whole financial planning syllabus and made it into a financial planning process and made it to a syllabus. Our vision is really to create 1,000 millionaire families to make a positive impact to our community by 2023. And the only way we can do that is for us to have more people who are financial capable, financial literate, and being able to spread more of this, just like what you're doing, like Casey. Thank you very much. So essentially, how do we help is this analogy I like to share is how we, just like how we want to get fit, how we want to get thin, right? Basically, J Academy is an education platform for people to learn to do it themselves, just like how we can lose weight ourselves. J Advisory is really a coaching and mentoring company where we focus on implementation and result. Just like how you hire a personal trainer to lose weight, because sometimes when you do it on your own, there are certain things that you cannot get the result from. So it's always better to get a financial or personal trainer. So in that sense, we are your financial personal trainer. Right? And of course, we work with other financial planning firms. The financial planning firm that I'm in is actually AD Financial. Many of you may not have heard of it before. But essentially, this financial planning firm is there to source for the medicine, like your Panadol and your gastric, depending on how severe your situation is. And sometimes certain people we have to operate them, like what you were saying just now, debt restructuring. So we probably have to put them on the operation table and operate them. Yeah. So the nutshell here is we really want to help you to smoothen your line, because life has already many ups and downs, right? So we just want to make life simpler for you. Before we begin, I'd just like to share a disclaimer that whatever we share here is simplified and presented in good faith. It doesn't constitute any financial advice. Do let me know any question along the way, right? We want to make it very interactive. So if you're ready to go, give me the thumbs up. We're ready to start right now. And today's topic is how we actually do it is we call it policy maximization rate. So as the word itself says, we actually maximize your coverage and actually optimize your premium pay. Can I share with you a case study first to actually relate this whole thing, right? Now, this case study I actually shared during the last webinar with Casey, right? I think Ian was hosting at the time. And what was interesting here is that this is an IT professional working in Singapore, right? So I think many of us have this entrepreneurial spirit in us. Of course, he's single, not married yet. But what I want you to look at here is that his liability, which is the red bar, is actually higher than his asset, which is the blue bar, right? So technically, if you are in this situation, we call it technically bankrupt already. But thankfully, because his cash flow was very strong in his Singapore IT work, right? We work with him, of course, policy maximization is one part of it. Of course, we also work with him in other areas. And you can see after 2 years, we sort of turning him around where he actually have more assets than liability, although his liability increased, right? So if you look at this details, what we were focusing on is the net worth. For your information, net worth is actually asset minus liability. So when you have a negative net worth, it's actually very bad because we're supposed to retire on the net worth. So if you have a negative net worth, how can you retire, right? So after 2 years, we sort of helped him to turn around 180 times. Of course, we cannot claim all the credit. It needs his active participation to turn him around as well, right? So how did he get into this situation, you may ask? Like I said, a lot of us are very entrepreneurial. He actually went into some business with some friends, but he didn't actively run it. He contributed, I think, about 150,000 Sing. Yeah, because he's working in Singapore. So after 2 years, that whole business, as we all know, right, Casey, after 5 years, they always say 80% of the businesses will fail, right?
Yes.
And then the remaining 20%, the next 5 years, another 80% will fail. So business is really a very high risk. So which our friend found out. So this actually got him into this situation partially because he had to service his debt. But as we dig deeper, right, we saw that besides the business that he was trying to invest in, the rest of his asset is mainly into his 21 different insurance policy. That's why we saw that something's not right because his liability, his loans, his personal loan, credit card were growing much faster at the 18 to 24% rate compared to, insurance policy, our savings maybe is like 2 to 3%. If you're lucky, maybe 4 to 5%, right? So essentially, the whole liability was growing much faster than the asset, which really is a problem. But because we are all so busy, right, we never really take time to sit down and look at one's financial to realize that. Right? So essentially, this is a financial health check which we recommend everybody to do. In fact, the last webinar, if you guys would like to refer, I think I believe Casey have this premium webinar subscription where you can actually go back and watch back that video, which we actually talk about how you can do a quick financial health check, right?
Yes.
So this is actually, cannot see, this is actually the list of his insurance policy when we actually put everything together, right? And you don't have to stretch your eye. We basically summarize for you already. You can see that he actually contributes about 12,000 SGD, which if you translate is about 36,000 ringgit. So let me give you the background, because this person is also a Malaysian. It's just that we have a lot of Malaysians now working in Singapore. So that's why he actually have a combination of both Malaysian and Singapore policies. So that's why when we put it together, we just, for easier sake, we just convert it to Sing dollar, right? And this is what we help him to do, right? So if you notice, we summarize everything, and later I'll explain to you what are these four key factors of four key coverage, right? But basically, he has about 700,000 of death and disability coverage, CI coverage, critical illness coverage of 305,000, hospitalization coverage of 711,000, and accident of 430,000. So that's how he actually got about 13,000 Sing dollar, right? So if you translate, it's about 38,000. And when we actually help him to go through this whole policy maximization process, can you see that, of course, first thing first, we have to understand his needs, right? Then only we can work out what is his true need of coverage. So you can see here, we sort of increase it by one time, about 1.3 million, 975,000 of CI. For the medical, he decides to reduce it slightly because he felt that he has, I think, 3 different medical insurance policies. So he say that it's good just to keep 2, one in Singapore and one in Malaysia. And of course, last but not least, we have 795,000 of personal accident. So if you notice, we help him to get a higher coverage in this case with a lower premium. So then you'll be asking me like, hey, how is it possible? Right? So this is what we want to move into the details of it, right? And after, when we help him to maximize, we technically save him about 27,000, right? So before we did this exercise, when we were trying to map out his retirement planning, it was very hard for him to hit because he couldn't have any savings put into the retirement. So when we got this 27,000, naturally the gap was closed, and he could meet his retirement goal if that money were to compound at 8% per annum basis. Are we okay? Because insurance and PMI is a bit drier. So do let me know if you've got any questions along the way.
Yeah, if guys, if you have any question, please use the Q&A box to ask the question. So I think this part is very interesting. So from 12,000, about 13,000 Singapore dollars kind of premium, and now we help him reduce it. But in the meantime, you reduce the premium down to like 3,800 a year, but his protection actually went up, right?
Yeah, basically we are using what we call a wholesale solution. And later I'm just going to go through and give you guys a bit of the what we mean by wholesale solution versus retail solution, right? So if you guys are ready, then the next part we're going to talk about the how and the what, right? How do we actually do it, and what is PMR, right? Are you guys ready? If you're ready, give me a thumbs up.
Yep.
All right. So this is a question that Casey asked initially. How many of you feel that you're paying too much for insurance? Right? I think he says it very well, like it also depends on your needs and also your income, right? So this is a rule of thumb, right? If you measure your insurance premium over your income, and if it's above 15% for your whole family, yes, then you are probably overpaying in terms of your insurance, right? We did we did a study like in 2014, every year Bank Negara will come out with this financial stability report. And what they did is that they actually took everybody in Malaysia, they take all the sum assured, right? And then they divide by the population, right? The average sum assured per Malaysian is about 57,000. And in 2016, right, that number went up by 5,000. So then the question that it intrigued us very much is that, over these 2 years when the average sum assured increased by 5,000, but the insurance premium increased by 5.1 billion, right? Then the question here is, where did the money go to? And through our experience, right, we saw that a lot of the money actually went into savings plan. So similarly, like that client of us, because we were being taught to save money in insurance, I think it's not wrong back in the 80s, because I think the interest return or the dividend return for a policy those days, Casey, correct me if I'm wrong, was like can go up to 6-7% or not.
Yeah, but FD also quite high last time.
Yeah, true.
Right? Mm-hmm.
So that's why when we see that most of us, when we say we have enough insurance, actually in reality, what we really meant was that we have paid enough insurance premium. It's not really so much on the coverage. So that's why the question of where did the money go is that this common misconception that insurance is actually not saving or investment, right? We talk about insurance being a tool, like what we talk about Panadol and gastric pill. Insurance is being used to protect our assets. Agreed? If you agree, type 1, right? And a lot of times we need to separate out in terms of savings and investment as a form of growing assets. I think this one is 101, right? But unfortunately, when most of us who are not very experienced in insurance, selecting the product, right? So we tend to buy a lot of those that actually come together, right? It's not your fault. It's just that it's the progress of the industry, I would say. In fact, if you count the cost of insurance, Casey, we did the calculation, right? The investment link, the traditional cost of insurance can be so much cheaper than the term policy. I think US is slightly different, right?
Yeah. US is slightly different because like the term policy, you can just go online and buy it, so they don't have to come to sell to you.
Yeah, I noticed there was one session that you hosted with Malik, and he was talking about iLife. Yeah. Yes. So I think that's a very good initiative for Malaysians because we see that the cost of insurance will come down as we continue, just like how our Singapore counterpart experience. So many of us in reality is actually overpaying insurance premium, but are severely undercovered, right? And I basically coined this term called policy maximization rate because I was trying to explain to my client, but I didn't know how to put it into a one-liner. So what does PMR mean, right? PMR 125 means that for every 1 ringgit of premium, basically you are using it to cover you 125 ringgit in terms of coverage, right? So let me give you an example. And a lot of people ask, is 125 good or no good? So in our past 12 years experience, we realized that if, let's say, when you do the exercise later, I encourage all of you to do it as well. If you find that your PMI is less than 100, right, normally is under optimized. And we've seen a lot of investment policy which is skewed towards investment and savings, then is really neither here or there, right? So it will be less than 100. If your PMI rate is 100 to 200, is somewhat maximized, but actually can improve further. And if your policy is above 200, then the higher the number, the better, right? But of course, we also encourage you that you have to make sure that each and every portion of your coverage component is being covered, because we've seen people who the PMI is above 200, but actually some components are 0. So you have to be careful on that. So let me give you an example of this person, Leela. It's not her real name. So what you want to do later, we've got a free gift for whoever is dialing in today, right? You basically get to download this template and you can do it on your own, and do share with us, what was your PMR rate. And what you want to do here is you want to put down your coverage. Although not many of you know how to do it, but actually I can show you, it's fairly simple. Once you get it, then you know how to do it. So what you want to do is to put each component like death and disability into each of the column, right? From critical illness to hospitalization to accident. You basically add up all the total coverage, right? For medical, it's actually we're looking at the annual limit, right? Because you actually have your lifetime limit as well. So then put in your premium per year, and that's basically how you get a PMR of 1 to 5, because the total sum of this divided by your premium, you will get 125 point something. So like I said, 125 is actually somewhat maximized. That means your agent really help you to max out based on the coverage, right? It's probably unfortunate, maybe he does not know that there are other solutions to that, which we'll share with you in a while. And what will be good is above 200 months. So if you look at the bottom example here, which is a maximized policy, again, after looking into her needs and her budget, she mentioned that she cannot really increase much. So we managed to just increase 1,000 based on her premium. And then the rest of it, we put it as close as possible to her needs. So she needs about 2.2 million because taking into consideration her housing loan and then her children's emergency fund, then her own critical illness. The hospitalization here, a lot of people ask, why is it lesser? So the real, I don't know whether you experienced this before, not Casey, but I guess nowadays a lot of people have more than 2 or 3 medical cards.
Oh, really? 2 or 3 medical cards?
Yeah.
Oh.
Because the old one is like 50,000. You know how those days we start
yes.
selling is what, 50,000 per year, right? So now it can come up to like 750 or 1 million, like some of the companies selling like 3 million. So what they will do is like, get a combination because you can actually claim, you cannot claim both at the same time, but you can claim one first, and then eventually the balance, if it's not enough, then you can claim the rest. So similarly for this lady as well, she actually had 2 medical card and 1 company coverage. So based on the company like coverage, and she wanted to keep 1. Yeah. So then she decided to, close one of the medical coverage. Yeah. So this is how it looks like. Basically a before and after. Even for Malaysia, we can have the similar experience, because a lot of people may be thinking like when we show the first case study, Singapore only is it? Maybe it's not relevant to Malaysian, but it is possible. All right, so far, any question or should I proceed?
We have questions, but I think it's best that we leave all the questions at the end.
Okay.
Right.
Cool. So the next part here, it leads me to the part where we were talking about just now, how if you have PMI of 200 already, what are the components of coverage each person must have? And then I'll go through the minimum coverage that one should have, because I think I'm sure some of the listeners here will be curious as well for that. Now, here's the 4 components that everybody must have, right? Okay, let's see. The first coverage is actually death and disablement. Surprisingly, in Malaysia, these 2, although it's a 2 different coverage, but normally it comes in together 90% of the time. Unlike if you see in Singapore and US, it could be separately. You can just get death coverage or disability coverage or critical illness coverage, right? So the next component is what we mentioned just now, critical illness coverage. The third component is what we call a personal accident. And the last component is what we call a medical card. Now, why is this all four needed is because this four coverage will basically cover 95% of whatever coverage that you need out there, right? A lot of people will be asking me, what about those advanced or early critical illness? I would say for those, it will be a good to have. That means if you have more budget, then you can actually go for it. That's how we plan, right? So, and the minimum coverage one must have. So we took the whole four components and mapped it into this triangle, because the most bottom is basically what you need most first, right? And it's naturally the medical coverage, because anything happens, you want to make sure that it doesn't come out from our own pocket, it comes out from the insurance pocket. But surprisingly, my son just admitted to the hospital before Chinese New Year because of a cut. I don't know why he every time have this cut and 7-8 stitches. I must say medical insurance in Malaysia the inflation is actually very high. Because 3 years ago, the whole bill came up to about 6,000. Then now it came up to about almost 10,000 just for 7-8 stitches.
10,000. Did he stay in the hospital for a few days?
Yeah, unfortunately, because he's still very young, right? So they have to put him into the OT, operating theater. So that's why the cost balloon.
I see.
Yeah. And secondly, when we talk about the second level, one must have is this part, which we actually call it the income replacement coverage. Now, income replacement coverage here consists of the critical illness and personal accident coverage, mainly to replace your income in the event that you cannot continue working. So I think in the financial planning term, we all talk about emergency fund, right? And naturally, we always talk about 3 months to 6 months. So over here is also another form of emergency fund, right? Which I'll share with you in the next slide. And last but not least is the death and disablement, which is at the top of the pyramid, right? So what's the minimum coverage? What's the experience in US, Casey, just to get a feel?
Here is really crazy. Well, the medical, if you're talking about the medical expenses in the US, I think it could be the highest among the world. Just give you an example. If you don't have medical insurance, normally the hospital will not take you. The doctor will not take you. Most of them, and it costs really costs a bomb. Like if you go to if you need or let's say you got fever and then you want to go to the emergency care to see a doctor, and then if with insurance, maybe out of pocket you have to pay maybe $100-200. But the insurance already covered like maybe 70-80% of it if you have insurance.
Yeah, I understand that US is something which if you don't have medical insurance, you can't even be admitted.
Yeah, like really, sometimes those people who work as a self-employed, or they work on like the hard labor, they do construction work or things like that, but they are not under employment and they work on their own. If they don't have insurance, so they can basically use up all their money just for one hospitalization. The whole year's income is gone. It could happen that way.
Oh gosh.
Yes. So here is crazy.
Because I asked this similar question to some of even the doctors in Malaysia, like what is the minimum coverage that you need, right? And I think 9 out of 10 people, they will say that 1 million is actually too much, right? Only one doctor in UM was telling me that actually 1 million is not enough if you happen to have a heart surgery or have to put a pacemaker.
Or like so organ transplant, things like that, I guess.
But organ transplant is not covered. I mean, in terms of the actual organ,
I see.
The operation of it is being covered, right? So how we actually derive this 1 million is because what we saw in every insurance company, they are actually providing similar type of range. So what we see is that if you can get a high coverage with a low premium, then this is the standard per year coverage that one should have.
Yeah.
Right. And then moving on into the income replacement coverage, which we were talking about just now. Imagine like the same emergency fund that we need to put aside. We can put 3 months to 6 months, right? But how many of us can actually book 5 years of cash? So it just doesn't make sense, right? So that's why we want you guys to look at insurance company just like another bank. You know how we like to borrow money from the bank, but we don't mind paying interest. So insurance company is the reverse of a bank, where you actually, the interest is like in the form of premium, right? But you're actually taking, putting your risk in terms of parking it into the insurance company, and you can free up your, maybe, you just put 10% of your 5 years emergency fund, even if you have the kind of cash. Then the other 95%, you basically can free up and invest and grow furthermore, right? That's what we meant by good financial awareness. And of course, last but not least is how much one should get will be if they are dependent, that means they have children and parents, or parents, then they should add up the outstanding loan amount together with the emergency fund, what they want to provide for if they are no longer around. Of course, naturally, it's going to be very hard to calculate. So normally we will suggest either you talk to us or you can just keep it simple first, because we saw that a lot of people, even the outstanding loan, they couldn't cover, right? So the minimum is to at least cover for that, because there's a lot of estate or property being stuck when one passes on. And I think you saw some report last time, they were saying like 60 billion of assets unclaimed. Yeah. Right. So this is our secret sauce. In case some of you might be wondering, like, how do you actually do it, right? But this is actually a sample I'd like to share with you. This is based on 2017. But we actually, minimum once a year, we refresh this to make sure that we actually have a apple-to-apple comparison. Now, this is actually covering the last part, talking about the death and disability coverage. And this is a sample of a wholesale solution, just in case some of you be wondering. And if you notice, the more yellow it is, then the more competitive it is. And this is actually for a 30-year-old male non-smoker, covering 1 million. Because I think a lot of people always wonder, even for myself previously, when I'm not exposed to this kind of wholesale solution, when you want to cover your loan amount, let's say 1 million, right? And you go into an investment linked policy, most likely the premium, it can cost you an arm and a leg. Right. So over here, if you notice, for somebody who's 30-year-old, for 1 million coverage, this is actually 1,380 per year. Right. So which is something which we use to help our clients to maximize their policy. And at the same time, we subscribe to buy term, invest the difference. I think I heard that term being used in your interview with Malik.
Yes.
Right. And I think it's a lot easier to do in Singapore and US. Back then, 10 years ago, when I was still an agent, when we tried to do it, it's a lot harder to do.
Yeah, we don't have this kind of products. Yeah.
Correct. So, any questions so far? Because I've come to the end of my presentation and we want to spend some time answering questions. And this is the part where I actually, if you're interested to download the ebook, right, and also the template, you can actually key in this, or if not, you can scan the QR code, and you can start doing it as per what we shared with you earlier, right?
Okay, great. So they can go to the URL here, and I guess they will need to enter their information. Then you email them the template and also the ebook, right?
Yeah.
Okay, great. So let me type the URL in the chat box so they can click on it. Okay, ups. Okay, guys, if you have any question, just use the Q&A box to type your question, try to get to it.
I saw somebody agent say keep approaching saving plans. I mean, the reason why I wanted to do this also is because you want to sort of create awareness that, you know, there's a way how you can sort of measure whether you really, like the first picture, you money, squeeze money out from that whole, every single cent on the money, no?
You know the things is that when we first started, I talk about this as well. So no, it's saving plan sometimes is much easier to sell because no customer they think that they can get back their money, right? So I pay for this insurance and I get back my money and I don't have to pay my whole life. I can pay 10 years, 12 years, or maybe as short as 5 years, 6 years. Now I heard that there are policies like 3 years. So customer is like, they are easier to buy the concept of like saving money. Okay, it forced me to save and then I get my money back and more with the interest. So you I don't think you can blame the agents for that because they are also running a business. So most of them will be
Right,
doing the, you know, they'll be selling the products that has the best benefit for them, right? And then easier to sell. Why trouble themselves to knock on cold call and then get people to buy medical cards? And when you get the medical cards, there are a lot of servicing to do. You know, whenever you want to claim, you're gonna call me, and I'm gonna have to serve you, and I have to run to the hospital a few times to get all the reports or all the signatures, and I earn peanuts from your medical card. You know, compared to the saving plan. Saving plan can buy 10,000 ringgit a year, but medical card you provide 2,000, 3,000, right? So it's just business capitalism. So let's get to the question, right?
Sure.
Okay, guys, please use the Q&A box to type the question so that it's easier to monitor. If you type it in the chat box, you can, of course, copy and paste it in the Q&A box for us to see. So, okay, BH is asking, you know, is this question is when you say based on the income, when you buy insurance based on the income, is it the net income or the gross income? Like,
We keep it simple, we use gross income.
okay, use the gross income. Okay, what is the formula for PMR?
Actually, if you download the template, right, the formula has been already keyed into the Excel one. But just to answer your question, it's basically every coverage when you add up together, the total sum of it. Let's say you have 100,000, 100,000, 100,000, 100,000. So it'll be 400,000 divided by your annual premium. That's basically your PMR rate.
So yeah, as you summarize, in a nutshell, is that 1 ringgit premium you pay a year, how much coverage can you buy with it? So that's the whole point of the PMR, right? So and by the way, if you're talking about medical card, you are taking the annual limit, not the lifetime limit. So just to be clear,
yeah,
because your premium is also annual, right? Okay. Thanks for answering that. Did you ask why he spent so much on premium in the first place? Why he's misguided? So the IT professional you mentioned in the case study just now, so he pays so much for insurance. So why did that happen?
You want to know the real answer? Actually, you didn't realize also. You know how when you're so busy, just taking care of your work, you know, because IT they normally work long hours, right? And when we actually put it down on paper, then you need to realize like, oh my God, I'm actually paying so much. But of course, when he found out the time, when we asked this question to him, he did mention also, just like I was sharing with you guys, how the perception of buying more insurance as a saving is actually, to him, generally, he's doing something good because it's actually accumulating, right? But it's just that I was telling him that, you know, there are other more efficient instrument or vehicle that you can, you know, put so to sort of help him to grow his wealth. So I think that helped him tremendously.
And I guess what you say is that when he pay like 30,000 ringgit of premium a year, so he pay that, and then when his business fail, then he actually need the money to pump into the business, right? And when he does that, when he did that, his insurance premium is still auto deduct from his credit card. So in the case that he doesn't have the cash flow to pay the credit card, so he lets the credit card debts pile up, right? Isn't that what's happening on his case?
Maybe I just share a little bit more in depth. So because when he ventured to his business, right, he was still keeping his main employment, right? So because his main employment, his surplus is actually very strong. Hence, that's why he didn't see that there could be a problem paying that kind of premium, and there was probably something in terms of the entrepreneur, the business, he was willing to risk, but he didn't realize that the business, when he failed, it cost him about 150,000, which ended up into his credit card and personal loan. And you know how when you're working in Singapore, your finances jumble up. You have some in Malaysia and some in Singapore, and then you start having some policy in Malaysia, then it's okay, then you continue. Then some in Singapore, then it's okay, you continue. So you just end up continuing, not knowing. I think that happens to many of us if we don't do this yearly check.
Yeah. So in this kind of situation, so let's say some of the listener here, if they are like feeling that they are paying too much for insurance premium and they feel that it is up to his neck, you pay until it's so hard to breathe for insurance premium. So if they come to you, they will probably get the solution, right? They can restructure the insurance, pay lower premium, but you still have adequate coverage. If it's not enough, you might help them to top up as well. And in that case, so I just want them to know the process. So when they come to you, they talk to you, and then when they engage you for the service, so you charge them a light consultation fees. So they pay you for that. And how about the implementation? So they do they buy the policy from you, or how?
So before we actually came up with this whole template thing, right? We were thinking, how do we allow them to DIY? But unfortunately, we don't really have an insurance aggregator model, just like we have an investment unit trust aggregator model, right? So unfortunately, right now, you still have to come to us because you wouldn't have the ability to be able to compare apple to apple comparison for most of the plans, right? And right now we are making it very flexible in such a way because Malaysian general fee base is not something popular. I'm sure you agree with that, right, Casey?
Yeah.
So when you try to force everybody to go ahead with that, some of them are not ready. Then we didn't want that whole experience of them, like, money stop us, from getting the better solution. So we are also working on a case-to-case basis that the most ideal situation, we see that if you have, in general, 10,000 premium per year, that's a lot more easier for you to see the benefit and the savings, right? We've helped people like 2004 premium, but they may not see the benefit of it because there is also some follow-up work that needs to be done, right? So it also depends. So far, we work very well with people who, say, 10,000 premium, whether is it for themselves or whether they have a family for it, that we can sort of value add more, they can see the benefits of it.
Okay, got what you mean. Okay, I want to know when we revise insurance policy, right? Usually, we'll be at a loss because when we surrender the policy, especially in the first few years, the surrender value is low. So, how do you cater this? Right? How do you help clients look beyond that?
So this is the second part which we didn't share today because we felt that when we share too much, then a lot of people will get confused. But this is related back to the question we were talking about buy term and invest the difference, Casey.
Yeah.
Right. So a lot of our clients, when they come to us, when we do this whole process, the cash value, we actually put it in as a way to help them to grow it. Because ultimately, like Casey say, nobody likes to pay insurance premium. They always hope to get some form of return or some form of break even. So ultimately, how we salvage that is to use the cash value, put it into what we call an invest the difference account to sort of grow it to the point, when you're 60, when you're retired, so that sort of help you to take care of the medical insurance premium that you probably still need lah. Because a lot of people didn't realize that towards 60 upwards, the cost of insurance of a medical insurance is very, very high.
Yeah.
So essentially the cash value is used for that lah.
Okay. Okay, Alex want to know, with the ever increasing medical costs, is 100,000 coverage for hospitalization sufficient? So most insurance companies now proposing 500 to 1 million kind of coverage.
Like what we shared just now, when we asked even the medical doctor, if it's a minor issue, then it's enough, 100,000. But if it's a major issue, it may not be enough, right? Because like I was just sharing my son, when he had 8 stitches on his chin here, getting into the private hospital for using the operating theatre cost me about 10,000. So thankfully, I was thinking like, wow, Chinese New Year the day before, no. I was thinking like, oh my God, 10,000 safe, and it's 10,000 earned, no. So we do not know when we need it, but essentially, this whole PMR is hopefully it helps you to get a good gauge, because if you have $1 million coverage on the medical, but you're actually paying very low premium for it, why not, right? I think that's the proposition that we're all hoping to get.
Yeah, especially nowadays, the new plan come up with like 500,000 and above, right? Compared to those I used to sell, like it start from 25,000 a year. I think it was like 2013 during that time. So those policy, in fact, are kind of like obsolete already. So you better talk to an agent or talk to people like Kaho to get to just increase your coverage and get to the competitive plan that is available in the market right now. Okay, David is asking, what is the difference between whole life policy and life policy? What do you think? Is it just name different, I guess? Whole life and life, I think it's the same.
Yeah. Ultimately, you have to look at the policy detail of it.
Yeah, and the policy name, every company come up with different kind of creative names. So
very, very creative.
Yeah, and then they can use the exactly same plan, slightly different, and then rename it. So every year you have a new name also. So that agent can go to you and say, we have got a new plan now. This year we got a new plan. But actually it's slightly different from the previous one. Okay. Okay, so but no, your insurance policy is the one that actually spell out all the term and condition. So you study that, you will kind of know what you're covered for. Jeffrey said, I'm a estate planner from Rockville. I've never really looked into my customer's insurance policy other than taking down the insurance company name, policy number, and sum assured. Recently, I have a customer with 2 million debt in mortgage without MRTA. And okay, that's the second part. And he's telling me that his agent from Hong Leong recommended Wealth Booster, which is a term. He has to pay 50,000 a year for 6 years. He will get back 300,000 after 30 years, which is about 93K in real value.
Sorry, I think my line was unstable. Can you hear me, Casey?
Yeah, basically, Jeffrey is sharing a case from his customer. So he has like 2 million mortgage. And then his customer was approached by his agent to buy this policy from Hong Leong called Wealth Booster. He said, which is a term insurance. He said he has to pay 50,000 a year for 6 years. Then he'll get back 300,000 after 30 years, which is about 93,000 in real value, but at least he gets something in return. So he's saying that this reminds me of the compounding interest table versus a Mr. Procrastination, where Mr. A invests for year 1 to 10 and Mr. B only start investing the same amount from year 11 onwards, and his return is less than Mr. A. So I'm thinking that 50K for 6 years ain't that bad. What's your opinion on this kind of policy? So the customer actually need like 2 million of coverage,
I
but
didn't get his question.
I didn't think he posed any question. He's posting a comment and need us maybe his opinion from us. So now his customers he needs like 2 million kind of policy coverage for his mortgage, and he has an option to buy a insurance policy which will cost him 50,000 a year for 6 years. But he'll get back the 300,000 only after 30 years. So my question is, Kaho, do you think his client should get this kind of policy, or there are in fact much better option to do? Oh, I lost Kaho there. I think I'm looking at his camera is still. Okay. Okay, I guess Alex Ho answered it correctly. He said, this is not a term policy. Yes, I agreed. I don't think it's a term policy. It might be a term policy, but it's a endowment policy, which is also kind of term because it's not whole life. It ends after 30 years, but you pay for the first 5 years. But I'm curious, like when you pay for the first 5 years, 50,000, does the customer get 2 million insurance, right? I guess that's how it works. Kaho, great to have you back.
Sorry, my line got cut off.
No problem. Great to have you back. So, do you know how the policy works just now?
I believe it's just like what you say, lah. It's just an improvement on the policy which they marketed previously, and the whole gist here is about appealing to people being able to pay up quickly and getting the coverage from that, lah. For me, I would still feel that you need to understand the intention of getting the policy. In this kind of case, it's still a very jumbled up, and it's not very clear. That's why it's very confusing. So I will still go back to getting the term policy as a separate, because the excess cash that you have, you basically can grow it, and it just solve the problem. Then you don't have to get confused over it, and you have control over that as well.
Yeah, I definitely agree with you. That means you separate it. You use the least premium to buy that 2 million policy. It could probably cost you just a few thousand a year, right? Instead of 50,000 a year for the first 5 years. Yep. But you save that 40 over thousand. Yep. You can invest however way you want it. Okay, great. Vincent asking, are you able to tell more on term sustainability versus term policy period? Which most term policy is 99 years, but that doesn't mean it will be able to sustain up to 99 years. To be able to have longer sustainability, most insurance will offer for the investment link policy. Okay. There are some industry terms there. Kaho, do you understand what he's saying? Okay, great.
Actually, yeah, I understand. I can take this question. Basically, an investment link, right, is a similar concept to buy term and invest the difference. So the sustainability, to answer his question of a term policy, basically, just to get the context right, Casey, you and me, we understand term policy is as long as you pay, the moment you don't pay, then the coverage ends, right?
Yes.
Yeah, so technically for term policy, there's no sustainability. The sustainability is whether you continue to pay the premium or not.
Yeah.
I guess the question he was asking maybe more on because term policy increases over time as you age, just like how an insurance policy is supposed to be. Why investment link premium doesn't increase over time is because essentially they are also taking your money to basically help you to smoothen the line, to average it up, right? So if you really dig into detail of an investment link policy, you'll be surprised that maybe it may not be able to sustain even up until 99 years, because it's more of still a yearly or 5-yearly check to make sure that the cash value is sustainable. The benefit of buy term and invest is different is that at least we have the control of where the funds is being invested, right?
Yeah. Yeah, great. So I think so, because Vincent is talking about this sustainability issue. Is that, when, especially when you're talking about investment policy, right? So investment policy, when you buy, they will generate a quotation for you, and then depends on the premium you pay. They'll say, if you will buy this kind of coverage, how long will it last, right? If you just keep paying that, they will project it based on a certain investment return. So it might last for 20 years, might last for 30 years, or some might last less than that. So that's the sustainability I think Vincent is talking about. So, but I'll tell you, I'll give you some tips here. If you're buying investment policy, it is so flexible that sustainability is an issue, but you also have the flexibility of taking insurance premium holiday. That means you don't pay. You don't pay when the policies have money, you still run. And so basically, sustainability is always in check, because as you age, your insurance cost is different, and insurance company also have the right to change the insurance cost. Because if you are there's a medical card put in there. Now it's this price. They give you a schedule here, and the schedule might be true for the next 5 years. But after that, they might send you another attachment, and they say that, oh, now the medical card increased already. So no, you will have sustainability issue as well. So whatever it is, investment is just, you got the flexibility. You can always top up. You can pay more. When the market is down, means your investment value goes down. Then you can pump in money, so we buy more unit at low price. So you can play around with all these kind of tips. But of course, if your insurance agent can explain all this to you, then he is a very competent agent, right? A lot of agents cannot explain this well. So if they cannot help you understand this, that means your agent is not competent. So you can look for people like Kaho.
Okay. Yeah, just to add on the top up option, I can see, because a lot of people don't really understand or know how to utilize the top up option. Because when you can, this top up is not the regular 100 per month top up, but when your units are down, you basically can top up 1,000 ringgit, and they just charge you like a sales charge of 5%.
Yeah.
And helps you to prolong the sustainability, right?
Yes. Isn't that a very good feature, right?
Good, but I think a lot of people don't understand and do not know how to use this portion, right?
Yeah. Because you know what? Agent also very lazy to do this for you, because he earned peanuts from doing that. And if you want to do that, he will probably I don't know now. Can you do it online? If you can do it online on yourself, then it's okay. Your agent say, okay, now you can top up. Then you can do. I think some insurance company might be. I heard of some insurance company can, if you have a e-account or e-connect account or whatever, you can log in and then you can top up with your credit cards. Then that will be very convenient. But last time, when the time we are agent, it's so hard. I have to collect a check from you and then have to go to office and bang in for you. My cost of doing that, it doesn't pay.
True.
Okay, great. Let's get to a few more questions, right, before we end. Okay, Barry want to know, if working in Singapore for long term, like 5 years, should we keep existing Malaysia medical card or just keep the one in Singapore?
Very good question. Thank you for reminding me, because I left out one point which I wanted to share just now. I think the question you need to ask yourself is whether would you see yourself as a PR in Singapore? Because a lot of my clients who started out working there and then eventually you become a PR. Mm-hmm. So if the answer is yes, you're going to stay there long term, I think then you can just give up your Malaysian medical card unless your cash flow allows it. Because tendency is that I think the charges over here in Malaysia is slightly more affordable in Singapore than compared to Singapore, right? Yeah. So if your cash flow allows you to do that, then you can actually have a choice, whether you want to come back knowing that, hey, this medical charges is actually much lower and is closer to home, right? That's another consideration.
In fact, talking about this, we have many friends in Singapore, right? So some of them become a citizen in Singapore. And some would say like we have husband and wife, so maybe one of them convert and the other one not. So they're still always in constant struggle, right? Whether I want to go back to Malaysia to retire or not, right? If you go back to Malaysia to retire, if you are still Malaysian citizen, even if you don't have medical card, you have the government hospital, right? It's still good enough to cover all your
Yeah.
medical expenses, right? Like the basic support. We don't have this here in US, but Malaysia has. So it's a good country to retire. But I don't know Singapore. If you convert to citizen of Singapore, do they have the government hospital that at least give you the base of coverage? Maybe you don't have the top-notch kind of service. Like in Malaysia, you go to private hospital, you get better services, right? Better room. But you go to government hospital, probably you don't get that kind of service. You have to line up, take your I mean, take your turn. So, this is always a constant struggle. But if you're thinking of just going there like 5 years, like the question, probably I would
Yeah.
say you should keep it, right? If you are thinking of coming
Yeah.
back just within 5 years.
You just keep it.
Yeah. Okay, why would you recommend term but not investment linked policy, especially if the term is not guaranteed renewable? So I think the example you
For
put up, like 5 years renewable.
actually the example that we put up, we make sure that it's actually guaranteed renewable before we propose it to our clients. Just to be on the safe side, because no point recommending something which is cheap but it's not equally good, then it defeats the whole purpose.
Mm-hmm.
Yeah. But I think the general understanding is that if it's renewable, then it's not guaranteed. But you need to look at the terms and conditions. The one that we were showing is actually guaranteed.
Okay, awesome. So yeah, I think there are pros and cons, right? So when you buy the term renewable term insurance, the premium is low, but you have to keep paying every year. So I think initially it will be lower than the one you pay for investment policy. But
Yep.
also investment policy, you have the trick of premium holiday. That means when you pay, it looks like let's say a 10,000 premium a year, but it looks like 10,000, but of course you pay 7,000, 8,000. It can go by too sometimes, right? Depends on the market, depends on your fund. So it also gives you a flexibility. I don't know. This is just my opinion. So
I
Kang He, what do
totally
you
agree
think?
with you.
Yeah.
I totally agree with you because you technically don't have a one size fit all. Of course, when we just started to work, I think an investment link policy is a very good solution because at the time we don't really have anything set for or planned for, right?
Mm-hmm.
But I think as you start to get your own house, get married, have kids, and then you realize that, oh my God, there's so much liability and so much commitment, then you want to actually go into, and also because our cash flow is going to be tighter as when you are married and have kids, right? So you really want to make sure that every single cent goes into making it count. I think that's the rationale of how we came up with this kind of solution.
Yes. Depends on your needs. So everybody's different. Jiajian want to ask about the investment link policy versus standalone plan. So which one is better? What do you think? I think the question is
Again,
a little bit vague, right? A standalone plan. What
yeah.
standalone plan? So let's say medical card. Like so, there are medical card that you can buy just medical card, and there are medical card that you can attach to investment link. So how about these two? What's your take on this, Carl?
I used because we came from the agency, right? So we used to think that investment link is a lot better until when we came up and see a bigger horizon and we start to put apple to apple comparison. Then we realized that hey, you can actually get a bigger punch for your buck in terms of the standalone plan. But of course, having a standalone plan, you still need to make sure that it's still guaranteed renewable and it's still competitive in the sense before you jump into it. Just generally comparing very high level, you still need to go into the detail. And I think one thing I missed just now was that when I show one sample, that one is just talking about the death and disability. We actually have other samples which are talking about the medical, the personal accident, which we already did the comparison on a year-to-year basis.
Yeah.
So if you guys want to know more, then just feel free to PM me and we can discuss further because it's very hard to do
Yeah, you're right,
in
Kaho.
general.
I mean, that takes a lot of work to compare all the plan too, because the plan also keep changing, right? Because all the insurance company want to stay competitive in the market. So if you beat me this year, I'm going to come up with a new plan that is going to be competitive with you. So so there's a lot of work to do. How many insurance company we have here in Malaysia? I mean, just life insurance company, how many is there?
The last I counted, I think easily 15 to 16,
15 to
including the
16, right?
Takafu. Yeah.
Including Takafu. So even in the same insurance company, you already have many type of similar plans to choose from. Whether you want to go with Takafu or not,
Right.
right? and and so we're looking at like saying medical card, you probably have 30, 40 plans out in the market, probably.
Yeah. It's
Right.
crazy. Yeah. It's a lot of work.
So I mean that's good if you know if you want to save time, you want to just get the best product, engaging people like Kaho, then it can help you save a lot of time and get you the right one. Okay, awesome. Let's answer just we have many questions. Just answer one more, and the rest of you, if I couldn't
Sure.
answer your question, can you copy it and you paste it in the Facebook video. So we have this exactly same video on my Facebook page, so we can paste it there. And if Kao had the time, there's no obligation. Kao, it depends on you. So if you have a time, you want to answer them. When I can look at the question and I'll be able to answer them, I'll have to answer as well. So post it there, and we're going to help you to answer
Sure.
it. Okay. Okay. One more question before we end. If looking for a family medical plan with above 1 million coverage with affordable premium, what would be the recommended product for the whole family medical plan?
I think last time it used to be very popular with family medical plan, but right now we don't really suggest family medical plan. We still suggest each person going on an individual basis because of some of the claim experience that we encounter, which is very complicating. It can make it very complicated. So give you an example, right? There was one case where this mom bought for the kids. So it's a family plan. So happened one day when the mom was diagnosed and eventually she exhausts her coverage. So the whole plan, because she's the parent, so the whole plan gone, And some of the kids who later on develop some medical history, you know how insurance company, when you have medical history, then you sort of get harder to underwrite and get it approved on.
Yeah.
So that's why when we encounter this kind of cases, then we will just recommend straight on from young the time they just get their own medical insurance, then it doesn't get into this kind of entanglement.
Okay, great. Thank you very much for taking out this time to help my audience understand more about this insurance. And of course, you can always maximize it using the calculate your PMR. Then you'll kind of know your policy maximization rate. So you kind of know where do you fall into. So if you are within 100 to 200, I think it's okay, but you might do better. You can still do better. But if you're falling into like PMR below 100, you definitely need to need to maximize the policy, pay less premium and get the adequate insurance you need. Okay, thank you so much, Kaho. Any last words?
Yeah, I just wanted to, if it's okay, just share with the audience. In case they want more details, they can actually contact me directly. And definitely really appreciate Casey for having me on this session. We'll try to answer all the questions in the FB Live, because I think the intention is really, I'm inspired by what you've been doing for the past 10 years, and it's not easy to continue to do it for so many years, right? So you set the bar high.
Oh, thank you very much. In fact, it's close to 10 years, I started doing webinar every week for the public since 2012, if not mistaken. So now it's 2021. So it's close to 10 years, in fact. Wow. thank you guys for following me all these years. So thank you very much. And before I let you go, next week we are going to have the Sifu of all financial planner, the giant of all, Mr. Yap Ming Hui. He'll be here to talk about when I was in this industry, I have to read all his book. Mr. Yap Ming Hui, you agree, right, Carl? So he'll be here next week to share. Okay, let me see. To share the 5 costly financial and investment mistakes to avoid in 2021. Okay. So if you want to get invitation to attend this webinar, just subscribe to my email list or follow my Facebook page to get the announcement. Thanks a lot, Carl. Really appreciate your
Thank you, PC.
kind sharing here. Thank you so much.